Welcome back to Collin Investing. Today, we're diving deep into the latest market movements and what they mean for your portfolio. We'll dissect key economic indicators, explore the fascinating story of gold's resurgence, unpack the growing global trade tensions, analyze the AI sector's boom and potential bubble, and wrap up with crucial updates on stocks like GameStop, Tesla, Nvidia, and more. Let's get straight into it. So, looking at the US economy, we're getting some seriously mixed messages. Consumer confidence keeps sliding, hitting its lowest since early 2022. Even more concerning, future expectations have absolutely plunged to a 12-year low, falling way below that 80-point level often seen as a recessionary warning sign. However, it's not all negative. New home sales did rebound a bit, and services improved, though manufacturing is still lagging. Right now, the market seems quiet, but these conflicting signals could certainly build into future volatility. Now, all that economic uncertainty naturally leads us to gold, which has surged to new highs, while fears of a U.S. slowdown and Middle East tensions are the obvious reasons suggesting its safe haven appeal. There are far deeper dynamics at work. We need to understand a significant underlying marketplace, so today we'll dissect gold's past bull markets and uncover the real drivers behind this current move. To really grasp today's gold market, let's rewind to its first major surge, the catalyst 1971. When Nixon severed the dollar's link to gold, largely due to massive Vietnam War spending that fueled inflation, confidence in the dollar crumbled, and gold rocketed from $35 to nearly $200 by '74. This stagflation nightmare culminated in 1980, when, amidst soaring inflation and geopolitical fears like the Soviet invasion of Afghanistan, Fed Chair Volcker's drastic 20% interest rates pushed gold to its then record high of $850 an ounce. Following that first surge, gold lay dormant for nearly 2 decades. Then, starting in the early 2000s, a confluence of factors ignited the second bull run. Think about it. China's entry into the volatile unleashed huge commodity demand, just as the dot-com bubble burst and the tragedy of 9/11 sent investors scrambling for safety. Then came the easy money fueling the housing boom, which ultimately led to the 2008 global financial crisis and the subsequent European debt crisis. Each event reinforced gold's safe haven status, culminating in that peak above $1,900. And that leads us directly into the third and current gold rush starting around 2020. Once again, we see a potent mix of drivers: unprecedented global money printing following the pandemic, heightened geopolitical fears from the Russia-Ukraine war and Middle East conflicts, and even anticipation of potential U.S. tariffs boosting demand. Layer on top the growing trend of central banks diversifying away from the dollar. Perhaps most notably, the U.S. itself has become the largest buyer, adding significantly to its already world-leading reserves. Now, that massive U.S. buying we just mentioned isn't random. It points to gold being seen as a key tool for financial dominance. It lets the U.S. hedge dollar risk while reinforcing its power over gold pricing. We're even seeing some U.S. states look at making gold legal tender again. And here is talk like Trump's sovereign wealth fund idea of using rising gold to attract capital instead of high rates. And it's not just the US. Globally, central banks set records, buying over 900 tons in 2024. Now, while central banks are buying and gold plays a strategic role, we absolutely must consider the risks. Gold isn't a guaranteed win. Remember how it plummeted after 2011? It also costs nations valuable foreign reserves to acquire. Interestingly, industrial use, like in AI chips, adds another dimension. But be warned, drawdowns can be severe. That's why a modest 10 to 15% allocation often makes sense for diversification. Beyond the moves in gold, here is a much larger gatal storm brewing: the rapid rise of global protectionism. As the Wall Street Journal points out, the speed echoes the 1930s, a time when the infamous Smoot-Hawley tariffs helped plunge the world deeper into depression. Today, we see country after country, South Korea, Vietnam, Mexico, even Russia, raising barriers, often aimed at China. The scale is staggering. G20 nations have over 10 times the import restrictions they did back in 2008, and the US is deep in this trend, with average tariffs hitting post-World War II highs and covering over 90% of goods categories. This isn't just noise, it's a significant shift, and potential new US policies could escalate things further. And this brings us to the potential next steps under Trump. We're hearing about possible reciprocal tariffs reaching as high as 50%, perhaps hitting cars, pharma, or chips using emergency powers. If this plays out, the average U.S. tariff could spike dramatically, nearing those concerning 1930s levels. Right now, It's deliberately unclear whether this is purely for negotiation leverage or revenue generation, adding another layer of uncertainty for global markets. Beyond those tariff clouds, another area attracting massive capital, and now some skepticism, is AI infrastructure. Alibaba's chairman, Joe Tsai, recently warned about a potential data center bubble. The concern: huge sums, hundreds of billions, are being invested speculatively building capacity before customers are even lined up. Tsai specifically questioned the sheer scale of U.S. projects. While Microsoft insists its adjustments are just restructuring, the worry about potential overbuilding in the AI gold rush is definitely growing. Adding fuel to those bubble concerns, Goldman Sachs just trimmed their AI server revenue forecast for 2025 and 26. They point to product transitions, like Nvidia's next-gen chips possibly slowing things down temporarily, and general demand uncertainty for training servers. Interestingly, though, they remain quite positive on inference servers, which is good news for players like MRVL and Bullish. But despite those revised forecasts, Nvidia's own CEO, Jensen Huang, remains incredibly bullish. He argues Nvidia will capture a massive share of the data center market because they're building integrated systems, not just chips. He envisions a future where manufacturing intelligence becomes a whole industry, and critically, he points out that smarter AI, capable of better reasoning, requires significantly more computational power. Speaking of companies making big strategic moves, let's pivot to GameStop. They just announced a major shift, approving plans to invest company cats potentially nearly $500 million into Baidu and stablecoins. It looks like they're taking a page directly from MicroStrategy's playbook, trying to use crypto as a treasury asset. While their recent Q4 profits did double, even GameStop admits this is a highly volatile and unproven path. Definitely one to watch. Alright, shifting gears from crypto bets to key realities. Let's look at Tesla. The latest numbers out of Europe aren't great, showing a significant sales dip and market share loss, even as the overall EV market there grows. Despite this, the stock itself has recently bounced, breaking past the $272 resistance. Technically, the near-term target could be in the $326 to $367 range. But watch that $238 support level. As always with Tesla, expect continued volatility. Okay, moving from the EV roller coaster to semiconductors, Nvidia and AMD seem to be taking a breather, trading sideways on lower volume, with AMD showing a bit more life recently now. Lam Research is flashing caution signs after lowering forecasters. 74.50 is the key support to watch there. Then you have the X-Cup plays. Marinat looks solid but stretched valuation-wise, maybe due for a pullback. MRVL has faster growth potential. Watch 67.30 support. It gets interesting near 60. Beyond the chip sector, several other stocks certainly made headlines. Trump media surged, fueled purely by speculation around potential ETFs. Keep that volatility in mind. Contrast that with the continued solid strength from Amazon and Meta, both outperforming the broader market. Google managed to break resistance, but the gains came on lower volume, hinting at passive flows. It really needs to convincingly clear the 180 mark. Then you have Big Bear AI, a cautionary tale indeed, crashing after having to restate its financials, worsening its losses, and finally Microsoft appears range-bound for now, facing significant resistance up to 430 and needing consolidation before any major move. Okay, wrapping up those individual stories, let's look at the broader market via the S&P 500. The key line in the sand right now is 5,700. Drop below that and we could easily test 5,500. But if the market finds its footing and pushes decisively past 5,900, that's a strong bullish signal. While indicators offer some support, the market's still walking a tightrope between recent inflows and those looming economic and tariff concerns. Navigating these complex market crosscurrents requires staying informed. That wraps up our analysis for today on Collin Investing. If you found value in this breakdown, do give this video a thumbs up and subscribe for more updates. I am keen to hear your your thoughts in the comments below, and as always, remember this is for informational purposes. Investing involves risk.